Every investor knows the golden rule. Buy low, sell high. Simple, right? So, why is the most popular investment in human history, the S&P 500, doing the exact opposite? Think about it. Right now, tech giants like Nvidia make up a huge percentage of the index. If Nvidia stock jumps 50% tomorrow, it becomes even bigger and more expensive. Does that mean your index fund is forced to turn around and buy 50% more of Nvidia at all-time highs? If cap-weighted funds force us to constantly buy stocks after they become expensive, is index investing secretly a trap? Here is the short answer. No, you aren't buying high. And understanding why reveals one of the most brilliant mathematical tricks of modern finance. The S&P 500 is a market cap weighted index. That sounds complicated, but here what it actually means. Imagine you own a single share of an index fund today. That fund already owns a tiny slice of Nvidia inside of it. If Nvidia's stock price skyrockets 50% tomorrow, the value of the share the fund already holds grows by 50% automatically. Notice what didn't happen. The fund manager did not execute a single buy order. They didn't take your cash and chase a high price. The price appreciation alone did the reweighting. Your index fund did not buy high. It simply sat back and watch your existing slice grow. In fact, cap weighting isn't a bug. It's the ultimate feature. It forces you to do something most human investors fail at: letting your winners run. Stock market returns follow a brutal power law. Historically, a tiny fraction of companies, less than 4%, generate almost all of the net wealth created in the entire market. The remaining 96% of companies, on average, barely outperform risk-free cash. If the S&P 500 forced a strict buy low, sell high strategy, trimming Nvidia every time it grew to buy failing cheaper stock, it would let off the very engine driving the whole market. Instead, market cap weighting naturally lets giant winners carry the index forward, while struggling companies naturally shrink until they fall off. Now you might ask, what about when I deposit new money in my 401k? Am I buying high then? Yes. When fresh money enters the fund, it buys the full basket at current prices. But that's not performance chasing. That's dollar cost averaging. If you're buying through market highs, market lows, and everything in between over 30 or 40 years, the only real critique of cap weighting happens when a new stock skyrockets outside the S&P 500 and gets added late, forcing funds to buy in after a massive run-up. But for companies already inside the index, price growth handles everything seamlessly. So, to make sense of it all, the S&P 500 does not chase performance by buying expensive stocks. It simply holds on the winners as they grow, automatically dropping the losers along the way. It's not about timing the market, it is about time in the market.